everyone, and thank you for joining. Good afternoon, good morning, perhaps good evening from wherever you are joining us from across the globe. I can see people tuning in from Tokyo, Japan, UK, Calabar. Thank you so much for joining, and Happy New Year to you. It's a new year, it's the beginning of a great time that we all can set our year straight and the ball rolling for great things to happen for us in 2022. Thank you for joining this webinar today. My name is Ademurayo Apara, and I am your host. On today's webinar, where we take a look at what 2021 was like in review and a forecast to what 2022 holds for us. I'm sure that as individuals, as small business owners, even corporates, I mean, everybody, countries, everybody, sets time at the beginning of each year to say, what is this year going to look like? What is the trend showing? And there are a lot of questions on our heart. I am very sure of that because of the way things have happened in the economic landscape, both locally and internationally. So there are questions to be answered. Questions around what COVID-19, I mean, it has refused to go away, with all the different variants that it keeps coming out weird at different times. What the devaluation of Naira, what does it portend for you as a small business owner? What does it portend for me as an individual with my paycheck? How is this going to affect me in my basic dealings at home? As a financial institution, how does this affect our dealings and the offerings that we bring to our customers? So we're going to look at this and as much as possible, try to answer the questions that we've got on our heart. And we have seasoned professionals that will do this for us. I mean, you can be assured that First Bank will bring the best to you all the time. So they are seasoned professionals, prolific industry subject matter experts that would answer the questions of what 2022 would look like and how we should position ourselves strategically. When you understand what to expect, given the projections that the experts are going to give to us today, you can then align yourself and make decisions in such a way that you are advantageous and positioned properly. So thank you for joining. Thank you for tuning in from wherever you're tuning in today. Please get your pen, grab a paper, get a notebook. No, don't grab a paper. Get a journal, get a book, because there is a lot that you're going to be taking in. All the questions that you have will be answered today, and you can begin to see what the year would look like for you and how to plug in your unique positioning and your unique need into what the outlook would be. At this juncture, let me confirm that I have the MD CEO of First Bank of Nigeria Limited on the call so that he can take us through the opening remarks. Could you please confirm for me that the MD is on the call?
Yes, I'm here.
Oh, great. So viewers, I'm happy to, with all humility, and this is such a great privilege for me, to welcome the MD CEO of the prestigious, most foremost, and the bank that is woven intricately into the culture and fabric of this nation. And we are not just local, we are also global. I'm happy, delighted to welcome Dr. Adeshola Adebuto to take the opening remark for this webinar. You're welcome, sir.
Thank you. Good afternoon, distinguished ladies and gentlemen, and great pleasure to welcome you to this First Bank's the Nigerian Economic Outlook 2020 webinar. And let me, on behalf of the board of our iconic institution, welcome our distinguished keynote speaker, Mr. Rewani, Bismarck Rewani, and other panelists. For us as First Bank, we are always very excited when we speak about the country. The moderator mentioned the fact that we are woven into the fabric of the society, and that is because from inception, First Bank has always seen our role not just from a profit perspective. We've always seen our role as that of a nation builder. So for us, we believe this panel that we put together, they will help us to do justice in dissecting not just what is expected in 2022. There's a reason why there's also a mirror that looks at the rear, even though that mirror is supposed to be small. And the one that is forward-looking is much, much larger. And that is what we expect them to do today. We are privileged to have the highly respected Mr. Rewani in our midst, an economist, a banker, a social commentator, that I would say is probably, okay, let me just leave it at that. Let me say that for us at First Bank, like I said, our role is not just about making money or focusing on ourselves. It's about helping the country itself to grow the GDP. That way, we believe our clients can grow and thrive, and we ourselves can grow and thrive. And that's the reason why we've been here for 127 years. 127 years. So there's a reason for that. So I want to enjoin each and every one of us to take part in this, listen carefully and contribute. First Bank, we are always open for business. And we remain a full service financial institution, from retail to commercial, to corporate, to investment banking. From retail to commercial to business banking. Clearly, there's a reason why we have thrived and we have excelled so far. So thank you. And I do sincerely welcome each and every one of us to this session. We're looking forward to a very engaging session that will be very beneficial to everyone. Thank you.
Thank you so very much, sir. Thank you, Dr. Adeshola Adedin. So thank you, MD. And I like the fact that, he reiterated, our essence as First Bank. We are nation builders. We build the economy and we build you. We are here for you. I mean, it's not just about profit. And that's why we have been here for that long and we will continue to be here. Okay, thank you so much again, sir. At this juncture, I'd like to bring, the big elephant in the room. There are many big elephants actually, but let me bring one of them. Our keynote speaker. This is an absolute pleasure for me and such an honor. I will read his profile in a bit before he comes on. So join me as I read through Mr. Rewani's profile, pardon me, please. Mr. Bismarck J. Rewani is the Managing Director, Chief Executive Officer of Financial Derivatives Company Limited in Lagos, Nigeria, a macroeconomic research and financial advisory firm. He has more than 30 years experience as an economist, banker, and financial analyst. He is a chartered member of the Institute of Bankers of England and Wales and a fellow of the Nigerian Institute of Bankers. He started his career with Barclays Bank International Limited in the UK in the graduate training program. He worked with economic intelligence of Barclays Bank International before joining the First National Bank of Chicago, now JP Morgan Chase. During a long stint in merchant banking with the First National Bank of Chicago, he rose to the level of the general manager and treasurer of the bank, which later came to be known as the International Merchant Bank Nigeria Limited. He retired from the bank to co-found Financial Derivatives Company, the leading economic and business research institution in Nigeria. Mr. Rewani serves on the board of directors of some multinational and Nigerian companies, which include Guinness Nigerian PLC, a subsidiary of Diageo, the largest spirit company in the world, Navgas, a subsidiary of Vitol, the largest oil trading company in the world, Top Fleet Nigeria Limited, First City Monument Bank, UBA Pensions, and a host of others. Mr. Rewani is a part-time facilitator of the macroeconomic program at the Lagos Business School, the executive breakfast session. He's also a renowned and acclaimed commentator on contemporary political and economic issues. It features regularly on many financial and business TV programs, including channels TV, CNBC, BBC, CNN, and France 24. This is an utmost honor, sir, to be able to anchor you. I've watched you over the years. I mean, when you are opportune to anchor one of the big people and icons in the financial industry, you don't take it for a joke at all. So thank you so very much, sir, for joining us. We look forward to gleaning from your years of experience and all that you bring on. Viewers, please welcome with me Mr. Biswak Riwani, our keynote speaker for today. Over to you, sir.
Thank you, Maiwa, for your kind words. Again, let me say I'm privileged and honored to be here. Shola Adedoton, your words and your messages are not lost on me. I'm in a company of many great minds here. I own Farid Zakaria, whom I call Farid Zakaria, my younger brother, Opeyemi Agbaje. I have Ini Ebong. So where do I start and where do I stop? But today, we're talking about Nigeria's pioneer bank, founded in 1894. It was 10 years earlier than that they had the Berlin Conference, in which Africa was partitioned. That's very important because the partition of Africa and the Berlin Conference led to what you have as the various colonies and protectorates. That was preceded the First World War. The bank was founded 3 years before the bronzes were stolen from or abducted from Benin City. And the bronzes that we're talking about returning today, and which is the catalyst for Edo State's tourism initiative. It happened 20 years before 1914, when the Nigerian southern and northern protectorates were amalgamated. So this is not just an iconic bank, it's a symbolic bank. It's a bank that resonates. It's been founded, accelerated its process and its establishment in Nigeria. It has been packaged, repackaged, and finally as a modern bank. And I must say, under the current leadership, what you call transformation that is how banks are transformed. So the big elephant has become a nimble elephant and is providing service for everybody. So you can see what an iconic bank, a traditional bank, has become a modern and contemporary bank and has actually become a digital bank. So without much ado, I would go into the discussion of today. It is in two distinct parts. Part one is about what happened in 2021, and we're going to ask a few questions. How did 2021 end? And in my program at the end of the year, Channels Television, I said that goodbye to 2021. Is it a year you want to remember or a year you want to forget? I said, what a year. It was the ups, the downs, there were bumps along the road, but that was how we closed the year. So we're going to ask ourselves, how much money did the government spend in 2021 and how was it spent? Did it make an impact on your lives? If you're an investor in Nigeria, how much money did you make? How much risk did you have to bear? If you're a corporate body, what kind of money did you make? And was there shareholder value or was there shareholder value destruction? Then as a normal Nigerian, the question is that in that presentation at the end of the year on Channel Television, we said strong data and perplexed people. What does perplexed mean? A perplexed man is a man who is puzzled, who is worried and cannot answer the questions. There are more questions than answers. So how did people fare? So then we gave an overall scorecard for Nigeria. Then the second part is about the 2022 prognosis. Prognosis tells you what is likely to happen. We broke the year into two parts. One, politics. The other one, economics. And then we ended up by saying what could go wrong in 2022. Being at the wrong place at the wrong time or being at the right place at the right time. And then we conclude. So once again, I'm happy to be here, the company of the best, the first, and also the rest. Thank you. Here we go. How did the government spend its money and how was it funded? Gave me a score of 40%. We had three things. We had the Economic Recovery and Growth Plan, which was I would say C minus. The economic sustainability plan, which did well, which ended up in 2020 but spilled over into 2021. Then we had a budget of 2021, which was fairly unmodest. And of course, we achieved positive growth in 3 of the quarters and negative growth in the first quarter. So this is what it looks like. The green line there shows you the budget in dollar terms, which was flat. The budget discounted for inflation is red, and the budget nominal. So you can see the blue line is showing growth, significant growth. And we went up to 13.59 trillion naira. But this federal government alone, don't forget the states have almost 42% of this as well. All the states and federal government all had a deficit budget. So in dollar terms, the budget increased by 6% in 2021. When you discount for inflation, it grew by 22%. So that's fine. How did we spend it? We spent 5.64 trillion on recurrent expenditure, and we spent 4.1 on capex. So if you take that, really, you will find that, and then we spent 3.12 trillion on debt service, and we spent 497 billion on statutory transfers and sinking. But don't be bothered about that. The most important things here are recurrent expenditure, which is 5 trillion, and capital expenditure, which is 4 trillion. And then we spent 3 trillion servicing debt. But the fact that you spend money doesn't mean that you had an impact. The fact that you spend money doesn't mean that it didn't leak. The fact that you spend money doesn't mean that it was spent efficiently. So let's go now to the next slide. This is what happened. We used 20% of our money at the federal level on works and housing, on roads, houses, and all of that. You have to turn around and ask yourself, you've seen the roads, you've seen the houses. If you didn't see them, then you ask questions, why and where are they? We spent 13% of our money, 256 billion, on transportation, rails, ports, blah, blah, blah. So you've got to ask yourself, are the trains working, or are they starting to work? And all in 2021. Power, we spent 10% of our money on power, 198. Do you have power? We're still at 5,000 megawatts. How many force majors, or how many blackouts we had, how many system collapses? Quite a few. But we're still languishing it with 5,000 megawatts full capacity and 4,000 megawatts grid power, and then about 1,200 megawatts stranded power. We spent 8% on water resources, and we spent 6%, 132 billion on healthcare. But don't forget, health is also both federal and state. So maybe in all, we spent about almost 250 billion naira for 200 million people. That's very low on healthcare. Education, we spent 6%, 127 billion, but federal education is, your unity colleges, your federal universities, and I don't think there are some military schools and all of that. So education is mainly state, UB, Universal Basic Education, and also we spend money on JAM, NECO, and all that. We spent 127 billion. Are we getting value for our money on education? We still have the illiteracy rate more of over 40%, so literacy is about 60%. We spent 6% on defense, 121 billion. And we spent 5%, 110 billion on agriculture. So you have to ask yourself what you spent and the impact it has on you. So if we spent on defense, do you feel safe and secure? If you spent on education, are the schools producing functional illiterates or functional literates? The healthcare, life expectancy is still 55 years. So we are going to interrogate all of this. So how did we fund it? We borrowed $6.23 billion new borrowing in 2021. We raised money from the central bank, 10 trillion naira, about $24 billion more as the federal government borrowed from the central bank. Luckily, the central bank has now priced that according to the market at 2% above the MPR, which is 13.5%. We raised 547 billion from corporate income taxes. And we raised federal government share of VAT was 235 billion naira of VAT. Because the states keep 85% of that. So the states had about 1.7 trillion naira from there. So this is where the money came from. Borrowings, overdraft from the central bank, and taxes. Let's break down the taxes. The taxes were as follows. We got 25% of our money from oil revenue. So petroleum profit tax, royalties and rents. Corporate income tax, 547 billion. And I will show you how many companies paid this 547 billion naira and how many of them swapped it for roads and all. Customs was 338 billion naira, but now that's looking better because anti-smuggling and close the border, we got 338 billion naira, 11%. VAT, of course, 7% of all the money. Signature bonus, 245 billion. Of course, you know, we now did the 5G thing at the end of the year or early this year, and we raised another $500 million. So that's a lot of money. Special accounts, whatever that means, we got 4.03. Electronic money transfer levy, we raised 9.8 billion. So for those of you who are transferring money and using your data bundle and doing all sorts of things, then what they call other revenues we got. So basically, the big elephants in the room are oil revenue 24%, corporate income tax 17%, customs revenue. Customs revenue includes import, excise, and other taxes, and then VAT. So that's what it is. Projected revenue was 7 trillion. What was raised was 3 trillion. Therefore, there was a deficit. So we sold some of these things. We sold government-owned enterprise, all these other revenues. So that's, you know, so now you know how much we spent, how much we earned, and how much we borrowed. So now this is our total debt in dollar terms. I don't know what it is about $92 billion. So it's up by 7%, by 6.2 billion. But this does not include, we drew some money from the IMF. They gave us 3.3, they gave us SDRs another 3.3. If we didn't get those $6 billion in addition to this, then we would have been borrowing more. So in all, we raised $4.6 billion externally from the Eurobond market, quite expensive, and we raised $1.63 billion domestically in Naira. So that brings us to our debt to GDP ratio of about 20% versus 18% in September 2020. The borrowing limit is now 40%, so we are still within the limit. But the point is that you borrowed money to do what? For whose comfort? To not make impact on who? So our debt to export ratio is 119, which means that if we use all our exports to pay debt, our exports will not be able to cover our debt. But we are a country, so as long as we service our debt, as long as we make provision for it, that's fine. It was 106% last year. So these are the blue line here shows you your total debt growing. The red line shows you your domestic debt, which is flatlining, and your international debt is increasing. So the question is that intergenerational debt, are you creating debts for the next generation? Are you leaving them? Because debts are liabilities. Liabilities have to be paid. So what assets did you use these liabilities to fund? Bridges, roads, refineries, blah, blah, blah. So you got to ask yourself on the scorecard, what have you done? Yes, you've gone borrowing. Yes, you have assets. Or did you use the money for consumption? Or let's break it down into three. You consumed, you invested, and some leaked. Okay, so here's the total debt picture. Domestic, $54 billion, external 37. We had from multilateral and bilateral, these are IMF, World Bank, and all the other multilateral agencies, AFDB. Those ones are soft loans with long moratorium and long payback period. We have 22 billion. Then the commercial debts, which are expensive and promising notes, are $15 billion. That has been good, right? And then you have Eurobonds, another $14 billion. But don't forget, yesterday, the United States announced that its inflation was the highest level in 41 years, 7%, which makes it imminent and inevitable, imperative, that interest rates will increase at least 3 or 4 times this year. When that happens, then the cost of your debt, international debt, begins to. At the same time, we must remember that since there's a midterm election in November this year, and the Democrats are in a bad shape right now, they need to do something to deal with inflation. What's the highest item in that inflation basket? in the United States, the price of gasoline. People are paying almost $4 a gallon, which is $1 a liter. That thing has to come down. How does it come down? It has to come down because they have to lean on Saudi Arabia, lean on Iran, and therefore one can expect, and we'll come back to the 2022 outlook, that oil prices are going to be volatile, but we should prepare ourselves for the fact that oil prices are not determined by the market. Yes, we say market forces, but this is driven by geopolitical considerations. And America has three major interests. You have what you call the vital interest, you have what they call the strategic interest, and you have what they call general interest. The price of oil is a strategic interest. And with a strategic interest, you do everything and anything possible with the mantra that all is fair in love and war. Government borrowing, this is what happened. Government borrowing, the red line. No, credit to private sector, the red line, and credit to the government is the blue line. So you can see that the government is borrowing. But what's happening? The government is borrowing at subsidized rates until recently when the central bank now driven the market rate. However, luckily for the government, we have something called CRR, where I put my money in my iconic bank, including First Bank, and whether they like it or not, 27.5% of it is taken away at zero and used to help fund Nigeria. So financial intermediaries are helping to fund the government, and the government is helping to fund your roads, your bridges, your hospitals, your schools, and your subsidy on petroleum products. That is the truth. Now, other economic indicators are important. GDP grew at 3.18 last year. We hope the numbers will come out soon. Inflation started as high as 17, 18. Official inflation, we are told, is now down to, the numbers will come out tomorrow, down to 14.9%. Average oil price for the year was up 63% to $70 a barrel. Don't forget, we were told that because the price of oil came down, the economy came, now the price of oil is up, the economy has to go up, not proportionately, but at least we've seen. Oil production was down actually 12.5% to 1.4 million barrels, but luckily, we are beginning to see an uptick. The gross external reserves actually grew by 14% to $40 billion. But don't forget, we also increased our borrowings. Okay. The Naira lost 20% at the parallel market to close the year at about 560. But also, it lost about 6% at the official window. So there's some convergence taking place. Our trading partners, Nigeria trading partners in the year 2021, we bought 38% of 38% of everything we bought in Nigeria was from China. Before, 5-10 years ago, when you say you're buying things from China, people say, please take that thing away. But now, 38 is 4 out of 10 things that we have are made in China. India, the other one, of course, medical tourism, everything, ICT. This is this year. Indonesia, 13.8, and the United States, 9.4, and Spain, 8.1. In 2017, this was the map. 32.4% was from India. China was 28.3. So you can see China and India are swapped. The US was 21.5 and it's down to 9.4. Why? Because they're not buying our oil anymore. Belgium, again, because of refined products, was 8.7, that's disappeared. And Spain was 7.1, Spain has increased. Now, what is interesting here is that we are buying goods from countries whose currencies are getting slightly weaker. We are buying goods from countries that have trade deals with us. We have the China-Nigeria swap deal. We have the Road and Belt Initiative. We have loans from China. We have this, we have everything, airports, power stations, refineries, everything from China. But the Chinese are also not the most charitable lenders in the world. If you default on your loans, of course, They don't take prisoners. So luckily we do not plan to default, and we haven't defaulted. But if we have to default, we should get ourselves ready for that. So again, fastest growing cities in the world, the 20 fastest growing cities in terms of population in the world. 5 of them are in Nigeria. Nnewi is the fastest growing, is the 3rd fastest growing city in the world. Has the highest pollution rate as well, 29.6% growth in population. The next city in Nigeria in terms of population growth is Abuja, 28.4%. Then Uyo, 28.3%. Then Port Harcourt, 25.6%. Right? Of course, you have Ouagadougou and all the others. Then Onitsha, 24.9%. So the bulk of population growth, migration into cities, are trading cities, not necessarily. So Nnewi, Abuja, Uyo, Port Harcourt, Onitsha. But I want you to note something. There are none of these cities that are in the southwest of Nigeria. There are none of these cities in the northeast and northwest. There are none of these cities, apart from Abuja, which is in north central. Everything here is in southeast and eastern portion of the south-south. It tells you something. So these are the cities I've stated here. You can see them. And right, so average growth rate of 27.36%. So people are migrating. And if you look at the migration, Lagos is, people are emigrating out of Lagos. And people are migrating to these other cities for whatever reasons. How did our currency perform? In the year 2021, these are the 5 African countries, or 4 African countries. Over the past 3 years, the Angolan currency lost 82%, Nigerian currency lost 55%, Ghana lost 26%, South Africa lost. But in the last year alone, Angola and Nigeria has the highest level of exports among these countries. Almost 19% of African exports are from Nigeria, oil, LNG, and cocoa. The Angolan currency appreciated by 13% after allowing it to depreciate. The Naira lost 20% in Ghanaian cedi lost 3%, and South African rand lost 8%. So that's it. We are still evaluating 2021. How did corporate bodies perform? These are the 5 leading companies: Dangote Cement, Nestle, MTN, Boa, Airtel. These 5 companies as a whole made 788 billion naira in PAT. That is equivalent to what the federal government and state governments share in 1 month. But they pay taxes of 386 billion and they employ more than 250,000 people. So you can see Dangote Cement. This is not the Dangote refinery. Dangote Cement revenue up 34%, sales of 101.02 trillion, PAT up 33%. Profit projection for 2022 is 320 billion. The refinery will commence operation. So just look at it. These guys make money by going to bed, right? MTN, stellar story. Revenue up 23%, 1.2 trillion, PAT 52%. That's why they want 5G, they want everything. Profit projection for this year, 340 billion naira. Increased capex, network capacity, bid for 5G technology. They have Momo, they have the PSB. They did the USSD thing. The banks are gasping for breath and they are going for their lunch. Now, here is Zenith Bank. Gross earnings up 1.9, PAT up 0.8. So legacy bank, largest, very aggressive brand and customer strength to deepen retail market, just like our host today, First Bank. They are in this space, FBN Holdings, FBN Bank. These are the leading tier 1 banks. What are they doing? Optimizing yields and at the same time spreading their tentacles across. They are becoming, they are fintech companies, they are asset management companies, they are investment banking companies, corporate finance companies. They are everywhere. This is so this is the PAT we have here. Nestle up 261 billion. And this Nestle, look at the corporate bodies here. All of them were rationing for foreign exchange. In spite of that, they still, top line went up by 23%, PAT up 5%. Projected profit for 2022 about 38 billion. And so what are they doing? Golden Morn, Maggie Cube, Milo, they have a brand portfolio Let's now talk about Guinness, Nigerian breweries, and Unilever. It's unbelievable what you're saying. So, but at the same time, the top 10 companies in South Africa had 15% growth, shareholder value, right? Revenue of the top 10 companies grew by 17% to 5.6 trillion naira, but accounts for only 2.6% of total revenue of the top 5 companies in South Africa. That is, all of these top 10 companies in Nigeria account for only 2.6% of materiality of the only 5 companies in South Africa. So we are still a small player in a big, big pond. So profit after tax in South Africa went up by 22%, 1.19 trillion naira, exceeded the GDP growth rate, and they paid dividends of so much. Now, and this is just a chart of the companies. You can see how they did, how well they did, all of them in green, all the way down to Zenith, GT Bank, Stanbic, First Bank, WAPCO. That's it. So these are the top, on the left is top 5 companies in Nigeria, on the right is South Africa. You can see the numbers for yourself. Total PAT in dollar terms, Nigeria is 1.3 billion. The PAT in these 5 companies in South Africa is $14 billion. So if you're an investor in Nigeria, what did you do? You gained about, pension funds represent investors. Assets under management grew by 5%. Portfolio weight exposure mainly to federal government securities. So the rates were not in your favor. Interest rates were much lower than the rate of inflation, but you were unable to beat inflation and you suffered, but you made some money. Your market at least stayed above water, gained 6% against inflation of 16%. If you invested in federal government treasury bills for 365 days, you got 5%. So you lost money every day. But the people themselves, that's why it says strong data on the left, perplexed people on the right, baffled and puzzled. And we've gone through the strong data. Positive GDP, total factor productivity, Brent oil, $70. You're ready to commission it. So things, commission the largest refinery in the world. Corporate profits up by 30%, stock market capitalization up. So these are the good things. You raised $4 billion from the Eurobond market. Airline passengers increased by 17% to 12.34 million passengers. Why? It's comfortable, it's safe, and it's safe from being kidnapped. It's better to pay a higher airfare than paying ransom. So this is how you feel. You had the fourth highest unemployment rate in Africa, 33%. Inflation was crushing you at 15%. Your income per capita dropped $2,000. Your misery index was high, you can see the weight on you, and your poverty rate was 53.9 million people in multidimensional poverty. So, in all, said inflation is going up, but this is our basket. Synthetic basket shows 88% increase in prices. The official basket says 15.4%. So we'll see what to believe in the end. Life expectancy, 55 years. Road accidents up 7%. Total casualties were up 4.57%. Air passenger traffic up 16%. The Naira down 20%. Diaspora remittances fell 0.6%. So you had that score. See, these are just states with the lowest casualties and states with the highest casualties. Ogun had the highest casualties in accidents because maybe the roads are good, followed by Abuja. The lowest casualties where there are no roads is Bayelsa. I think there's only one main road going through the town, going through Yanagua. Then there's Akwa Ibom, low accidents, and Borno as well, because nobody was traveling because of Boko Haram. Now, this is in terms of traffic, we had the worst year. Lagos had the highest traffic downtime in the world. 1,080 hours were spent in traffic in Lagos. Abuja wasn't that bad. Other cities, Kano, Benin City, and others were had traffic. So we spent 12.3% of the time in Lagos traffic. And computed in years, we spent about 6 years to live in Lagos out of 55 years. So this was how you looked in 2017, and this is how you look today. You are slimmer, you are leaner, and you're ready to run. In 2017, you were obese, and this is just a 5-year average is what you have. So goodbye 2021. That's what we have. So government spending was scored an E, investors E, corporate got A and B, and the people got an F. So average score E. What next? 2022. Economic policies and reforms. 2022, politics will be different from 2021. We have 2 elections in 2022, Ekiti and Osun. The game changes. You are going to have facial recognition, biometrics. It's easier to perform than to try and rig or to buy votes, because what you are buying what you can't see. No, the fact that you give people money doesn't mean they will vote for you. As a matter of fact, they're so illiterate, they won't know what your symbol is. And they probably vote for your opponent without knowing. Oil price is expected to average between 70 and 85, but don't forget the American factor, and that thing can go down to 60. Oil production up, CBN likely to increase forex supply to manufacturers. Buhari already announced that. Pre-election spending will drive up cash, but also we're going to see more roads, more projects. Everybody is going to be commissioning projects from culverts to Boy Scout camps and all of that. Everything to make it look good. Then 2 major documents, the 5-year development plan and the 2022 budget, all look good, driven by private sector initiatives. I think we have some interesting days ahead. But then let me start by saying that this year started on a very good note. And we had the EIGP, which expired in 2020, which is not so good. The newly approved 5-year development plan. We have the sustainability plan, and we have the funding strategies to broaden the tax base, making things more efficient. And then we have to deal with the big elephant in the room, which is, the subsidy issue. So this is the budget, and we've heard it and we read it, and I guess we're all bored about it, but that's what it is. So scenario A is legacy. We have 370 days to election. We have almost 410 days to handing over. So what will be paramount? Legacy or business as usual? This is a legacy profile. Reform oriented, driven by need to leave a legacy. This is election neutral. Who cares? Since I cannot stand for election. So whilst you guys are worrying about who to vote for, we are going to have people who are trying to do the job that we have to do. And breakfast is the most important meal in the day. The morning is the most important time in the day. So the president kicked off one. First announcement was that I want inventory of my economic performance. I want independent-minded people to look at and take inventory and compute whether we have had value for money or whether we've just been having propaganda rather than analysis. So, number 2, I appointed Chief Economic Advisor. Very important, because now they say better late than never. Let's get going. 3 is that the ban on Twitter was lifted today. So Twitter lift means what? It means that open communication. You can abuse anybody, you can do anything, you can do whatever it is. Therefore, transparency and the demand for transparency, demand for good governance, demand and accountability, holding people to account means that they have to do the right thing. There's nothing you can do. We've seen what's happening. We've seen what's happening in Magodo. We've seen what's happening in Darwin College. We've seen what's happening everywhere. People are asking questions and answers. You can choose not to answer. You can choose to be mute. You can choose to have amnesia. You can choose to have selective inattention. But at the end of the day, you must answer. Because, and I put out my poll yesterday. I asked 4 questions on Twitter. Yes, I was tweeting, even though Twitter was banned, but who cares? The reality is that question number 1, I want to rule Nigeria. Question number 2, I want to run Nigeria. Question number 3, I want to serve Nigeria. And question number 4, I want to lead Nigeria. Guess what? I want to rule Nigeria. 4% of the respondents say that's the correct answer. I want to run Nigeria, which is to manage Nigeria properly. It's 25% of the answers. I want to serve Nigeria, that is, serve the people, was 60% of the answers. And then the guy about leading Nigeria, whether from the back or from the front, was marginal. Therefore, the bulk of the Nigerian people are saying they want to be served because they are the bosses, and they want to be managed properly. So whether we like it or not, that's what it is. So 1, take an audit and inventory of economic performance and tell us the truth. 2, give me a chief economic advisor who can tell me the truth and look at me. 3, open up the space for Twitter so that we can serve Nigeria. And you will only serve Nigeria if you are ready to answer questions. And the answers are now. So in this scenario, say fuel subsidy removal. Okay, fine. Oh, there'll be riots, strike on 27th of January and 1st of February. But come, let's think about it. 3 trillion naira is all that we're talking about in subsidy. 3 trillion naira is less than 2% of the size of the economy, 160 trillion naira. PMS is only one item. PMS is only one item of the many fuels. The bulk of the fuels, diesel, kerosene, cooking gas, everything are all deregulated. So when I did the analysis, 118,000 trucks come into Lagos every day carrying food into Lagos. 90% of those trucks are fueled by diesel. Only maybe 10% or so are fueled by petrol. Therefore, how much is diesel? 345, 350 naira. How much is petrol? 165 naira. So how come? How much is kerosene? So as far as I'm concerned, there is these things are there. And then let us ask ourselves, what's the inflation rate in Ghana? What's the inflation rate in Benin? What's the inflation rate in Togo? Inflation rates in those countries are much lower than us. However, they have deregulated petrol. The only people who will lose from PMS deregulation are those who are at Idiroko by the border, who are smuggling petrol across the border. So they've screwed us for the past 20 years. It's about time they did some work for a change. Now, cost-reflective tariffs, we know what it is. Cost-reflective tariffs and the battle over Magodo and all of that, the truth is that where there's embedded power, where people are paying cost-reflective tariffs, power supply is more stable, rents have increased, businesses are going there. And that's why there's a battle about, oh, who owns Magodo, and the police are fighting, the government is fighting. Why? People are fighting where there's value. The Finance Act to be amended, VAT, will VAT be increased? I doubt it. Digital tax here, there. Twitter is supposed to pay tax for whatever it is. We're going to have convergent floating exchange rate. I think so. Central Bank is going to have to do that, and they will have to increase supply and environment. These are the things that will drive it. And if we did this, then we are likely to achieve what we call a legacy, what we call more of a dynamic equilibrium. Subsidies cannot be eliminated, they'll be reduced, fiscal deficits will decline, interest rates will increase again, I think so, before the middle of the year. Deficit financing was funded because of subsidy removal and some of these things. But the point is that the fact that you move money from people's pockets to the government, and the government, if the government does not handle it properly and does not manage it and deliver to the people with everything available will demand it and will get it. Therefore, it's up to policymakers, regulators, financial intermediaries like all of us in this place to make sure that we do our job and reduce the stealing. Okay. So I'm not going to dwell too much, but these are the things that what they're going to look like. And it's quite clear that 2020, 2022 should be a better year than 20 if we adopt this approach. But we have another approach, which is steady state. Do nothing. Oh no, you know what? The people are going to strike, bribe the unions, they will strike and they will close down everything. Yeah. Then we continue smuggling. Then we continue. So, we keep interest rates low because we are subsidizing sectors. Go and look at the subsidies. Only 23% of those who took some of these intervention loans are servicing them. Many of them took the money, the next thing they were in planes to Dubai to buy all sorts of things. So this is time for us to deal with our reality. And the elections will tell us that. What happened in Edo State, what happened in Anambra State is a point of the fact that, like I said, it's easier to work hard than to try and look for question paper in the exam. So if you like, or go to a Marable to go and get, to help you pass your exams. That's not going to work. If it worked before, if the Marable was that smart, he would have been teaching in the university himself, right? And be teaching voodoo economics. So this scenario assumes that nothing will go wrong, but things will go wrong whether we like it or not. And things will go wrong in even the first scenario we painted. And this is what the outcome is. I'm not going to bore you with it, but CBN will deplete reserves, MPC will raise interest rates. This is our own scenario, best case. Cost of effective tariffs, CRR will be lowered so that banks can lend more. We go back to orthodox lender of last resort. OMO will be used for liquidity management, not more than 180-day maturities. And there'll be a single yield curve. The FGN will securitize, basically they will securitize their debt. It is cheaper. 10-year bonds are cheaper than borrowing money from the central bank at 13.5%. So why don't you just take the 10-year money? The stock market will rally and FPI inflows will increase. So will elections disrupt our politics? I don't think so. Economic? No, because Nigeria has to mature, right? But, so this is what the GDP will look like. At the end of the year, it'll be 3.9, higher than population rate, and it's moving in the right direction. Inflation will increase before reducing later on. External reserves will go down to 30, $30 billion because we have to support the currency. And the exchange rate differential will drop from all the way and begin to converge. So the Naira will strengthen based on whatever scenario, election, no election, but in the end, that's what you see here. Because we have learned lessons. Those who do not learn from history become history themselves and are bound to make the same mistakes. So this is what we have, H1 economics, H2 politics. So presidential campaigns kicked off already. You know that even if you made $1 billion Naira profit in 1 week, it will not make the front page of the newspapers. But if you go to the primaries and carry some brown envelopes and get some delegates, that will be the cover and back page of the newspapers. So people are not interested in what they want to know, whether what's going to happen. And they now know there's a strong correlation between good politics does not necessarily mean good economics. Good economics does not necessarily mean good politics, but definitely bad politics means bad economics. So what are we going to see? Airports concession. I've left out Air Nigeria yet because when we see it, we believe it's supposed to start in 90 days with new aircraft. Dangote refinery will be completed towards the end of the year or early next year. Fertilizer is already rolling out. 5G adoption is already there. Roads will be tolled, and those guys who are tolling the roads will maintain it. You'll be secure on those roads. There will be drone technology to see whether to reduce the kidnapping. There'll be affordable housing. These are the things that are going to be happening almost simultaneously with things that you see. Sector opportunities, ICT. This sector is growing. 120 billion, what the federal government budgeted, but 120 billion is nothing. MTN alone and Airtel are going to spend over $2 billion on telecom infrastructure. Because without that, the Momo and the Smart Cash and all the other things will not work. You will not be able to use your PSs. Remember when they shut down all the casinos and Zamfara, and they said, shut down the base stations. Nobody told them before. They said, please come and open it, because shut it down or not shut it down, people are still kidnapping. As a matter of fact, they will kidnap more when there's no business. So now they say, please just bring the business so that we can do whatever it is. So everybody's back. Everybody's aligned. Telephone penetration will increase. Fintech and mobile payments will increase. You know right now that cash in circulation is 4 trillion. Money supply is about 45 trillion. So cash in circulation only 10%. The bulk of it are electronic payments, e-commerce, e-payments of everything, right? Sector will consolidate. Telcos, same thing, and I'm running out of time. And construction sector will also grow. I've mentioned that. Financial services will grow. Again, financial services will go in 2 ways. I remember I used to tell people that 10 years ago, 5 years ago, if I'm going from Gerard Road to Lekki or back, I'll be probably pushed aside by 3 or 4 bullion vans, maybe from First Bank, GT Bank, or Zenith Bank. Oh, no, give way, we have to carry cash to the branches. Today, I'm more likely to be pushed aside by some big rich man who is trying to go to a party with his or politician going to a rally with his mobile policemen and have mobile. So what has happened? Transfers and cash, everything is now being done electronically, right? That's what it is. That's the reality. It's a new reality. Manufacturing, you know the drill. Nestle, Unilever, Cadbury, Guinness, Okomo Oil, Presco, livestock feed, flour mills of Nigeria, you name it. These are the guys, they pay our bills, they keep our people employed, and they need to be encouraged to invest some more. Right now, they are doing this even with limited foreign exchange. Can you imagine when they get plenty of foreign exchange, plenty of things still, everything will be done. And don't forget, we signed the African Continental Free Trade Agreement. Whether we like it or not, people can produce outside and bring to us, and we can't stop it. So we better encourage people to produce here and sell to the outside world. Can things go wrong? Things will always go wrong. What they call it, Murphy's Law. When things want to go wrong, when it rains, it pours. So what are the things that will go wrong? Policy reversal and delayed reforms, social unrest, Nigeria falls into a debt crisis. God forbid, I don't think it will happen. Financial sector crisis and default, not likely, because capital adequacy ratios are there, but don't forget, there is a forbearance that will run out in February next month. If it is not extended, some of us are going to be scratching our hair. If price of oil falls below 50, then we are in trouble, but I don't think so. Heightened insecurity, outbreak of COVID. COVID is not a problem because we've all had it and have had it again and again and again. And the only way to actually prevent yourself from COVID is to have it and give yourself a 90-day break and have it again so another 90 days. So have it 3 times a year and you're okay. So it's better, it's cheaper than vaccination. There are no symptoms. Now, big problem. The time between misunderstanding and violence used to be longer, but this time it's going to be shorter. So reduce the misunderstanding so that you reduce the violence. That's the electoral risk that we face. Even without elections, we already have a problem. If you add elections into it, add terrorists into it, add vandals into it, add bandits into it, add pirates into it, add black acts into it, you have a potent mix. That's a perfect storm. So, in summary, 2 halves, good year for the economy. We will go in with reform. We have no choice. Reform could be impeded by political considerations, but the people that are the impediments to reform are the same people that are fighting political power. So they will be distracted by political power, while the reform economists can do at least whatever is left of the unfinished business. Insecurity will be tricky. Let's not deceive ourselves. Insecurity is here. It's more than endemic. CBN, we believe, will increase forex supply and try to converge rates so that we can have an efficient exchange rate management system. We don't have one now. Pre-election spending will be done part for show and part for real. So we will have some performance. Inflation will increase first before it declines. Monetary tightening, we will have higher interest rates by the middle of the year. And we will struggle when interest rates increase in the US for March next month or 2 months' time. So debt service will be a struggle. Real GDP growth will be modest, but we still have work to do. Competition between banks and fintechs, they will cannibalize themselves, but yeah, customers will enjoy it. And the banks will be, in fact, more profitable because if you look at everywhere where fintechs and banks have come together, they become more, and as far as the banks will be more efficient. I said at the beginning of this presentation that First Bank reinvented, repackaged, restructured, and actually repositioned themselves in this period. Why? They didn't do it voluntarily because somebody woke up. They did it because they had no choice. That's why Shola did what keeps him awake at night is how can I reposition and sustain the reform? And I think it's done a good job. So banks, constant innovation, regional diversification will remain resilient, but they have to cut down costs. One of them says they are closing 50% of the branches. They are not the only ones. We're going to see that, but then shift resources to other areas. But one of the big problems with innovation and creativity is that it displaces people from jobs. The people selling cards on the bridge, people selling recharge cards, people cashiers, the bullion van driver. These are, if nothing is done for them, they are the kidnappers of today, and the bandits of tomorrow, and the pirates of the day after tomorrow. So we have to do something, and that's why you need growth, you need investment. And that's what the future is all about. Thank you very much, ladies and gentlemen. It's my pleasure again.
Thank you so very much, sir. Thank you so very much. That's so much to take in, a lot to take in. Can I have a round of applause in the comment section? Mr. Irani has done a great job dissecting, the review of 2021 and the outlook for 2022. Please let me say our thank yous and a round of applause for him. Thank you so much, sir. So much to take in. I would have loved to run through a summary of what he shared, but we still have a really, really engaging plenary session. So I will dive in straight into the Q&A now. We have quite a number of questions for you, sir. Let me just go right in. We may not be able to take everything. Perhaps we are unable to take a question. Apologies, we will answer them and put them together, collated as we share the recording of this session in our registered emails. I hope that is fine with us all. Okay, so running along quickly, first question that I would like to take from here is from Gerald Lutana, and he says, please, how will all these borrowed heavy amounts be repaid, and what have they been channeled into? Can you hear me, sir?
I can hear you very clearly.
Okay, great. So this is making reference to the heavy borrowings that was experienced in 2021. Can you give us an idea of what these borrowings were spent on? This is the question that Gerald is asking from here.
Okay, let me say that my understanding that most of the borrowings were used for three major items. One, complete pending projects, i.e. you have the Lagos-Ibadan rail, and you have a couple of things. Some of the borrowing was used for consumption, which is paying for your subsidy and your imported petroleum products. And part of the borrowing was spent in servicing debt. Okay, so you have three buckets, but to be honest with you, the borrowing ratios are still within comfort, but the alarm bells are going off. Because don't forget, all the new borrowings, we are not paying interest and principal yet. We are paying accrued, but the next generation, or the next government that comes in on 1st of June 20 or 30th of May 2020, next year, will have its work cut out for it. So there is a need to interrogate and question every new debt, right? Because borrowing for the sake of borrowing and borrowing, but one important thing, if you increase your loans and you don't increase your productivity, he who goes at borrowing will go at sorrowing. I think Okpayemi and others are going to throw more light in the panel, but I know that they will do more justice to this than I can ever do myself.
Okay, thank you very much, sir. I have this question from Biola Olanio, and it says, good afternoon all. The federal government used to maintain excess crude account to cater for the differences in oil benchmark price of the budget and the actual recorded in the end. What has happened to these accounts since 2015, most especially in 2021, that we had over $30 variance between the benchmark and the actual price?
Okay, that's a very interesting question. But you see, the benchmark, there are two benchmarks. There's the price benchmark and there's the production benchmark. when you now say that the price was $40 and the actual price was actually $80, so there's $40. However, there was also a 60% shortfall in the production. You were projecting 2 million barrels, but you actually produced 1.4 or something like that. So when you net it out, there's still some money that's supposed to have accrued to the excess crude account. That money is not there. It's either lost, leaked, or spent. I don't know. All of the above, maybe. But also, what was in the excess crude account before now had been raided. Sometime it was raided quite a few years back. And so there's nothing left there. But that's the honest truth or inconvenient truth. But I'm just being brutally frank.
Okay, thank you very much. I have this question from Aroyon Sukomi, and it says, from the recent discussion on Channels TV with the president said 2.5% or 25% of land in Nigeria are arable, hence we should go back to farm. Does that mean that all sectors should be jettisoned for farming? The other part of the question, we can take that during the plenary session. What would
Can you come again? Your voice kind of dropped off.
Okay. Can you hear me clearly now?
Yes, better.
Okay, great. So I have this question saying there was a recent discussion on Channels with the president where he was mentioning that the arable land in Nigeria is about 2.5% or 25%. The person isn't certain. But question is, should we jettison all other industry and go back to farming? There's a second part of the question, but that one we can take during the plenary session.
Okay, I know that quote. It was from Doyin Salami, my chairman, who said that only 2% of arable land is irrigated. And we have about 400 or 500 irrigation projects in this country. What they are irrigating, the water where it's going, where it's, it's a mystery. Therefore, with poor irrigation, you are likely to see cattle rearers moving and all sorts of things, and it leads to a series of problems. So we can't abandon it. We have to make them work. Irrigation has to, you dam the water, use the water, and then you can use it also for power generation. Because don't forget, hydropower is responsible for only about 5 or 10%. Kainji Dam, right? And the reason why we put every megawatt of power we produce in the country, the first place it goes to Mali, because the Futajalon Mountains, where the Niger River starts from, is there. If they dam that river, then we are done. We are done. It's business. It's game over for Nigeria. The entire Nigeria will be dry all the way to the Atlantic Ocean. So we can't. So that's why if we have 100 megawatts, we give 80 of it to Mali first, so that they can have power. So there's no need for them to dam the river. Second is, how do we now use all this other, even the Benue River, how do we ensure that this things happen? We've been voting money for years since I was born into these things, but nothing happens. Well, so that's why Doyin Salami said that from the reports that we have, and the president held on to it, and the president has kept on saying it. But words are not enough. But at least saying it first and then doing something later. I think that's where we are. We are, at least it has been identified, as I mentioned, and we must do something about it. Or else, again, it's lights out for Nigeria.
All right, thank you very much, sir. I'd like to take this question also from Omolara Akonji. And she asked, saying, I'll be delighted to have Mr. Riwani explain the interlinkage between foreign direct investments, imports, and exchange rates. Secondly, how do we remove the leakages from the waivers given to businesses and entrepreneurs who are making profits at the expense of the foreign exchange waivers?
There's a guy called Prodon who says all profit is theft, right? And to be honest with you, that is not true. The mindset that profit is theft is the biggest disincentive to investment. For every time there's a profit, there's also somebody making a loss. I don't hear people going around looking for those who have made losses to see how they'll be compensated. So profit is a reward for risk taking. Profit is a reward for vision and all of that. But also profit is a reward for speculation. So what you want to do is to say, okay, how are those speculating with foreign portfolio investment, breaking it? No. Once you have an efficient exchange rate that is market driven rather than subsidized, nobody goes around speculating on the sterling or the dollar and all that. You just kill yourself. You're more likely to lose. So what are we saying here? We are saying that have an efficient exchange rate. But it is the inflows that came from foreign portfolio investors, some of them hot money, that helped to keep the currency where it is. Once we had all of these restrictions, those monies disappeared and the gap became clear to everybody. So INE, Ebong and others are going to address this issue. The markets, the foreign exchange market is a dynamic market. It's tied to your local market. Your rate of inflation, your rate of interest, that differential determine how much. So if that is what it is, if your interest rates were 19 and your money supply growth was, your money supply growth was 19 and your output growth was 2%, your inflation rate is 17%, you don't need a calculator to do that. It's there, it's clear. It's as clear as night. So let's stop practicing voodoo economics, right? There are too many quacks, right? So let's practice orthodox economics and allow things work. The markets work, they're efficient, right? The invisible hand is more efficient than the hidden hand. So whether we like it or not, we are going to do it because we have to do it. We are going to do it because we need to do it. And we're going to do it because if we don't do it, they will shut us down and write us off. And again, I will end up, if we don't do it, it will be lights out for Nigeria.
Okay, thank you very much, sir. So there are 3 questions around borrowings that I would like us to take as we close this first.
Why don't we shift those questions to Okoyemi, Ini, and others, because they are going to be answering these questions in their debate. So I think that it's more efficient that way. And Austin, Udin, and others.
You'd like us to take it during the plenary session?
Absolutely.
Okay,
Thank
great.
you.
All right, thank you very much, sir. And
thank you very much for having me. Thank you, Shala. Thank you, everybody.
Please do not go away. We still
No,
have
I'm not
the
going.
plenary session for you. Speaking to our viewers, I believe that the first part of this webinar has been very insightful and you have learned a lot. Be rest assured that we will share the recording with your registered email addresses. Without further ado, because we've got time, we don't have so much time, rather, we would move into the plenary session. And Mr. Rewani has given us an overview of what 2021 and the outlook for 2022 is. Right now, this plenary session is going to be looking at how your financial institution is positioned to support you in 2022. Okay, and to take us through this session, I have heavyweights in the house who are going to take us through this plenary session. In no particular order, allow me to introduce to you Mr. Ifeanyi Udin, who is the Chief Economist for First Bank of Nigeria Limited. Mr. Ifeanyi, you are welcome. Thank you for joining us today. Could you please unmute, sir?
Thank you.
Thank you. Mr. Ifeanyi will be the moderator for the plenary session. Next online is our keynote speaker, who just took us through this amazing session, Mr. Bismarck Rewani. Thank you again for being available for the plenary session. Thank you so much for your wealth of experience. Next up, we have Mr. Okoyemi Agbaje, and I'll do a quick read of his bio for us. Mr. Okoyemi Agbaje founded RTC Advisory Services Limited, a leading strategy, policy, an economy business advisory firm in 2004 after a successful career in banking and financial services. He left the banking industry in June 2004 to pursue his passion for business strategy, economic, financial, and policy analysis, research, and advisory services. He holds a master's degree both in law from the University of Lagos in 1989 and an MBA from IESC Business School from Spain in 1997. He served as a legal officer in First Bank of Nigeria PLC from 1989 to 1990 before joining GT Bank in November 1990, rising from banking officer to assistant general manager by 1998. He left the banking industry in 2004 as an executive director. Okoyemi Agbaje is a member of the Global Strategic Management Society USA and served for 2 years as a representative for Africa of its strategic practice interest group. We are delighted to have you join us today, sir. Thank you for bringing your work.
Thank you very much.
All right. Next up on our plenary list is none other than our very own Group Head, Treasury and Financial Institution, First Bank of Nigeria Limited, Mr. Ini Ebong.
Good afternoon, everybody.
Good afternoon, Ini. Thank you so very much. So I would hand over at this point to Ifeanyi, who is going to moderate this plenary session. Please have your questions come in. We'll take some of the questions that we have from the first session. Over to you, Ifeanyi.
Thank you. My understanding of the remit of this plenary session is that we're going to help the banking market walk through the different scenarios that Bismarck has just painted. Fortunately, if you were to draw a line through the banking market, it conveniently splits into three. So there's a consumer retail bit, there's the corporate business bit, and then there's the public sector government bit. Okoyemi, would you take the first shot at walking the consumer type customer through how the financial services sector will help them navigate the different scenarios that Bismarck has put before us? Thank you.
Okay, fantastic. Yeah, Bismarck has, and correctly so, has both good news and bad news for consumers. So first of all, if you listen to him and watch the data, inflation will probably continue to be a concern for the consumer, shrinking his wallet and increasing the cost of consumption for the consumer. Of course, when he has some savings, he'll be interested in also getting some, preserving his capital, first of all, and perhaps hopefully getting some returns on all of that. On the other hand, if Bismarck is optimistic that we may finally deal with the issue of petroleum subsidies, while those of us enlightened economic analysts and business people are fully conversant of the arguments for that, consumers and you may say organized labor remain unpersuaded or perhaps unwilling to be persuaded of the arguments for that. So there are issues around that. Prices again of petroleum products will, if we do get to tackle that issue in 2022, will go up, and we may expect some, as is typical with Nigeria, we may expect some industrial volatility, at least a little bit of it if we're successful. I must say that I'm still watching. I hope I share Bismarck's optimism that that issue will be dealt with. I think our friend doing Salami's appointment is a strong signal that it may be addressed. I think the president has a lot of difficult economic decisions in 2022, and perhaps may want to professionalize the communication and the decision making in that regard. So yeah, the appointment of doing suggests that we may be ready to take some bold decisions. So like I said, on the other hand, GDP growth is gradually inching up. By Bismarck's projections, we may finally go above the rate of population growth in terms of growth. Some sectors are picking up. If you looked at Q3 data, you would see that trade is beginning to pick up, real estate is beginning to be in positive territory. Of course, communications and information has been strong. Agriculture remains problematic, and I think that there's finally evidence that insecurity and disruptions of agricultural value chain are affecting food production and prices. So I think investors, consumers will be concerned about food and its prices. They were strongly concerned about that in 2021, and I think those concerns will remain in 2022. I guess that's a snapshot of what I think is in all Bismarck has said from the consumer point of view.
Of the three buckets that we have conveniently broken this conversation into, Bismarck seems to suggest that the business sector came out the better of the three into last year. Given that he also thinks that we will have a convergent sort around the exchange rate of Naira, and this I know is the bane of that sector. What's your take from the perspective of the business
sector?
Yeah.
Well, at first I was concerned that Bismarck focused the analysis on the corporate sector, on the top 5 and then the top 10. But I think in spite of that, maybe unrepresentativeness of the entirety of the business sector, I think I still share his general assessment. If you look at GDP performance from the beginning of the year, if you look at sectors, you see more and more sectors returning to growth. So yeah, by and large, the business sector, and then of course the big firms obviously have done quite well. The larger banks, the larger corporates and so on. So yeah, the corporates have done better than consumers, have certainly done better than the investors. For 2022, I think that the central bank has sought to move towards rate convergence. It's been tough, but they've been continuing the struggle. I think that, again, back to the fact that the government appears willing to take some tough economic decisions. And then the fact that the government maybe has fewer and fewer options. So we would have to deal with these issues of rate convergence. If we want investment, we'd have to deal with the subsidy. If we want stable finances. For me, the most worrying thing for me about Nigeria are probably the fiscal risks as they increase. But I think that yes, business will always cope. Business is beginning to has been dealing for a while with consumer resistance, consumer purchasing power. But in the end, the business is always dynamic. And yes, it should continue to fare better than the other two in 2022.
You have run the treasury function of what is arguably Nigeria's most involved bank. What's your take on Opeyemi and Bismarck's respective perspectives? I mean, at least from the perspective of your function as a treasurer, supporting the corporate sector.
Well, I think it's been a very interesting period of time. I mean, if you think about it, we had the last crisis barely, 5-6 years ago. We dovetailed into the second one, which was COVID-induced. And we've seen similar effects on corporate Nigeria, the issues around FX illiquidity, the inability to sustain the momentum of importation, inability to source foreign exchange in a timely manner to liquidate obligations. But we've also seen a resilience of corporate Nigeria, who've learned how to adapt and navigate this. And as both Bismarck and Mokbeyemi have mentioned earlier, the corporate sector came out quite strong. Again, when you have dysfunctional markets, you create arbitrage. So arguably, most of corporate Nigeria, if not all of corporate Nigeria, especially the top and middle tier and the larger SMEs, have benefited from that. Embedded FX arbitrage, which translates into their bottom line, and we've seen that. At the end of the day, hardest hit, as they've mentioned, has been the consumer, who has either suffered it via price increases or volume reduction for the same items that are sold. So it's been a tough one for corporates. Arguably, it has meant those that have been able to work with their bankers to enhance their treasury capabilities, which basically revolve around how they manage their cash flows, their forecasting, how they manage their FX risk, how they're able to take advantage of the products that are available to help mitigate those losses, have come out the stronger. I tend to agree with both of my co-panelists around we are at a point where things must change. So it does suggest or does appear that the central bank is moving towards convergence, which is a good thing, because yes, we've seen the central bank intervene in a number of ways, both in the foreign exchange markets, also delving into the fiscal space with all sorts of interventionist schemes and all of that. But I argue, and I am a firm believer, that the markets are a better allocator of capital to where it's needed in a much more efficient and transparent way. So as they move towards convergence, as we move towards normalization, I hope, of monetary policy, where we have the yield curves behave properly, where we have the foreign exchange markets behave properly, I think it brings a lot more transparency to the economy. And I think overall, we are all winners, whether it's corporate Nigeria or the consumers, the nation as a whole. And I think it's much better for the overall economy. And I think it looks like that's where we're headed in 2022. And hopefully we get that way. Thank you.
Bismarck, you described a slate of reform initiatives that government should pursue if we're to see the needed growth rates that the economy should have. Do you think the e-Naira, I see that as a question across the chat rooms, do you see the e-Naira as qualifying for this? Is it part of the reforms you'd anchor policy around?
E-Naira is one of it's a part of the package, but in terms of the impact and its magnitude, it's nothing. We're talking about 200 million or 1 billion in a 47 trillion Naira money supply spread or money supply chain in a 160 trillion Naira GDP. I haven't come across anybody who has, in the past month or two, has to pay me in e-Naira. Neither I don't even have an e-Naira wallet, but it's good to have it there. But what is electronic? What is cryptocurrency? What we call the CBDC, Central Bank Cryptocurrency. It is another medium of exchange. One, two. It also, again, some people say it's a hedge against inflation. Not really. It's an asset class. So should I use it as a medium of exchange to invest, or should I store value? I think the entire cryptocurrency space itself is, maybe I'm too old to be able to take those risks. I'm satisfied with what I have. I'm satisfied with my checkbook, I'm satisfied with my cash, satisfied with my payment systems, mobile banking, internet banking. And I have enough problems with that. To add the e-Naira to it is going to be, but for the young ones, I think it's welcome. I don't know anything about Bitcoin. I don't know anything about Doggy coin and all the stable coins. And I, quite frankly, I don't want to know. The last time I checked Bitcoin, it was about 60, got all the way to $65,000. This morning it's about 40. So some people lost their shirt. Warren Buffett said Bitcoin is rat poison. And I think Berkshire Hathaway returned something like almost 70% last year. And that's for an 89-year-old. I think it's about 89 now. So he must know a few things. And he says the rule of investment is rule number 1, do not lose money. Rule number 2, do not forget rule number 1. So I'm following his steps very carefully. I don't have much, but I can't afford to lose it.
Opayemi, if the search for allocative efficiency is the central argument for handing pricing decisions to the market, does it make sense for some authority to restrict the directions in which the market could go? And I'm referring to Bismarck's position here on cryptos and the likes. Yes, cryptos are not stores of value, but as asset classes, would you, for instance, be restricting the punting on gold?
Okay, I am, let me first make a general statement. I'm a bit wary of our regulators, including financial sector regulators, of their over-inclination to control. And that have manifest, whether it's investment, whether it's crypto, whether it's currency, whether it's even the direction of markets. I tend to believe, especially in evolving markets in which you're not so sure of the outcomes, that the market is still developing, and you need a little bit, even in telecom spaces, we've seen the telecoms regulator and the government ban Twitter and unban it today. I mean, so we're beginning to see this inclination towards control. I'm very wary about it. I believe the role of the regulator is to monitor, to regulate, to check the direction, and except there's some clarity about something going wrong, to be wary of clamping down on markets. Having said that, I think that I would like to focus Nigeria's economic conversations on the fundamental questions. And the fundamental questions for me are, how do we secure greater investment in this economy, both foreign and domestic? And what are the constraints to investments? And we know them: FX convergence, maybe enabling environment, insecurity, and some aspects of policy. How do we get rid of the dysfunctional subsidy regime and improve government's revenue efficiency? How do we deal with electricity sector reforms that appear to be stalled, more or less? Are we, as I think Bismarck's scenario suggests, are we ready to embark on the difficult? For me, it's difficult. Already, I think I shudder at the rate at which my prepaid meter runs up. But still, at the level of policy, when are we ready to get to cost-reflective electricity tariffs and therefore stimulate real investment in the electricity sector? Those major questions. How do we address insecurity, which is now becoming a major economic concern? Those are the broad questions, or some of the broad questions. I'm happy about 2021, in which the PIA happened. Thank God we did that. It's not perfect. It needs to be improved, and stakeholders are unhappy about some segments of it, but it was a major step forward. Are we now ready to implement courageously in the context of an election season, the provisions of the Petroleum Industry Act. As for crypto and e-naira, I think these are facilitative developments. I appreciate the CBN introducing that weapon or that tool or that product and so on, because of course it wanted to control the development of crypto and then provides its own alternative to it.
Bismarck, Okpayemi's contribution reminds me of Margaret Thatcher's quote about deregulation not meaning the absence of regulation. So if we're going to move a lot more of domestic transactions onto the market, is there an argument for strengthening the regulatory infrastructure? And next question is, how may we go about this?
I think what the Kwame is saying is right. Let's deal with the fundamentals before we go. Let's go. I mean, Kwame's model, or his mentor, Farid Zakaria, says three things. One, stop doing dumb things. Two, start doing smart things, then before you start doing modern things. So first of all, let's stop doing dumb things. Let's call a spade a spade. The first thing about, even before you talk about fundamental, number one thing is data integrity. Once the data is massaged, or you can play with the numbers as much as, but sooner or later everything will come out in the wash. I'm sick and tired of data management for show rather than for reality. So once you know the correct data, once you know how many people are in the house, then you can know how much food you provide. If you keep on playing games with that, then you can. So first thing, let's be sure that the MBS is well funded, well manned, with people who have the qualities and qualifications. Let's make sure that is done. Let's make sure that we rely on that data. Make sure that we rely on the research department in Central Bank is manned by quality and qualifications as well, and rely on the data, right? The same thing in the debt management office, same thing, the pension office and all of this. So separate policy making from regulation. Once policy making is to alter people's behavior and confidence, regulation is to control people going out of line. But what has happened is that regulation and policy making has converged into toll gates. So we need to begin to go back to the basics. These are fundamental. Until you start separating those things, until you deal with data integrity, until you deal with separation of regulation from policy, until you deal with knowing that the goal is to influence, change people's behavior voluntarily, because they are all rational economic agents. These are basic, but again, that's why I said, look, let's stop having marabouts as economists, and let's have economists not becoming marabouts. That's all.
Ini, Bismarck envisages renewed pressure on the price of our main export item, crude oil. He also thinks that we'll see a drop in the balance in the gross external reserves. And yet he's persuaded that we'll have a convergence in the different windows in the foreign exchange market. What's your take, sir?
Well, arguably with oil prices hovering around the $80 handle, we must all admit in the year 2022 that is an unlikely event. I.e., what I mean is that I think the risks are more tilted towards oil prices coming down, given the whole global mantra around energy and how we're transiting. And it's really a play on global geopolitics. Yes, will the OPEC Plus hold? Will America and China start releasing reserves to manage this down so that we don't harm global growth? So yes, there is significant downside risk that oil prices will come down. By extension, it then means, given our own balance of payment situation and our import requirements, we will run down our reserves, which is not necessarily a bad thing. Reserves are meant to be spent. when we need them to support the currency. So it then means that the currency will need an adjustment. Today, from where we sit, the currency trades officially between 411 and 435, right? And that's where it is sold by the CBN, who today remain the largest supplier of FX into the market. Like I mentioned before, on account of some of the unorthodox policy measures that they've had to adopt, we've created a dysfunctional market where there is a lack of FX liquidity. So a lot of the traditional or additional sources of foreign exchange that historically has come into the country, especially in the last 5 years, where we saw significant flows from foreign portfolio investors, have stopped. So it then means the currency will weaken, or should weaken, or should converge. Today, we all know that the parallel market, or people are transacting bilaterally far in excess of 435. So at some point, we will find that there will be a move towards convergence where the true willing buyer and seller will meet and then transact, so liquidity increases. So I think it is likely, because if we don't adjust, we then just continue to fuel the arbitrage that I mentioned before, because the demand for foreign exchange is there, and it is human nature. If people can see that they can sell foreign exchange at rates higher than where the central bank has fixed its rate, and there's active demand for the currency at that point, like any other commodity, people will seek to sell it there. And as you increase regulation or rules to stop it, you just drive more and more speculative behavior. Now, today you will ask me, is the currency, because I understand the black market is in excess of 500 naira to the dollar. Now, is that where the currency should be? I don't know. But I will tell you there's a fair bit of speculation behind some of those numbers. And if we get policy right, if we allow markets to function a little more efficiently and properly, then we will see, we'll get convergence and find a level that is and that's what we will see.
Opayemi, I saw you nod enthusiastically.
Yes, I obviously wanted to make one or two comments. One, the hint in your question is clear, and I agree with you. I think that, first of all, the biggest failure, in my view, in the policy environment over the last few years is that we've essentially wasted an oil price crisis. First, in terms of the opportunity to align exchange rates, the opportunity to deregulate petroleum prices, the opportunity to encourage investments by having a realistic exchange rate, and the opportunity to diversify the economy by allowing rational investment into sectors rather than people playing on rent. And so we've gone through the entire oil price crisis, 2 recessions, and we're still as dependent on oil for our FX and for our government revenue as we were at the beginning. So that's a crisis wasted. American policy always takes advantage of crisis to do reforms. We've not done that. We essentially just borrowed to fill the gap in the hope that when prices correct themselves, we will go back to life as usual. Unfortunately, we're doing that while the fundamentals of the industry are changing globally, climate concerns, global geopolitics, and all of that. I totally agree with you. President Biden came into office and for ideological reasons seemed to place climate over oil prices. Now he's going to pay for that. It appears he's going to pay for that at the ballot box, and he may rewind that policy a little bit. Bismarck also hinted at that. So I do agree that globally there'll be pressure on the oil prices. And I suspect that if convergence will happen, it will be an upward price convergence rather than at the current levels of. So I totally agree with Ini in terms of how he sees the evolution. If we do embrace convergence, we're likely to see much higher exchange rates.
The next question is for both of you. Bismarck envisages a rise in interest rates sometime this year. That's domestic rates. Standard economics says that you raise interest rates to help hold inflation down. We're seeing the Fed, we've seen the ECB and the Bank of England commit to higher rate increases. How high do you think domestic interest rates need to be in order, one, to help hold inflation down, and arguably to also help combat the run on the exchange rate? Ini, you first.
Yeah.
Okay, thank you. You know, the debates around the Holy Trinity are endless. But I think there are a few fundamentals that we need to consider, you know, when we look at the Nigerian market. I'm sorry, guys, but fundamentally, Nigeria is not a low interest rate environment. We are not, right? I think at best, for as long as I've been active in the markets here, I think we've gotten inflation down to just about 8% or thereabouts, and never below. Certainly not in the last 10 years have we been able to achieve lower levels of inflation. So structurally, we're a higher interest rate environment, right? That's number one. Unfortunately, post the crisis, and we never fully recovered from the earlier crisis of 2014-15, in my own opinion, things have gotten worse, and we've allowed some significant dislocations between the interplay of interest rates, inflation, and the currency. So we've got pressure on all three fronts, right? So when I look at interest rates today, where we've kept the government yield curve at sub 10%, it simply does not work. Structurally, I think there are core inefficiencies within the economy that don't support that. My sense is that Nigeria is a low-teen interest rate environment, right? And that's where, and when you think back to where we've seen some semblance of macroeconomic stability, wherein we've been able to some measure, bring down inflation, where we've been, to some measure, have a realistic foreign exchange rate, where we've seen market forces play the way they should. Those are the kind of levels we see. Certainly today, with the divergence between the official and parallel market, where it is today, if we're looking at some form of stability, inflation is heading towards 20%, or it's in the very high teens. My sense is we've got to move interest rates up. Interest rates, and when I say interest rates, this is the government curve. This is not the credit curve to the consumers, right? Which is much wider, right? So the government curve, which is the anchor, needs to be, in my view, mid to low teens, right? So that's the 12 to 14% handle. Now, when you overlay the credit spread on that, that's an additional anywhere from 300 basis points all the way to 10 to 15 basis points, depending on what part of the spectrum you're in. Are you top tier major corporate, or are you an SME player? And that's unfortunately is reality, right? And that's the only chance we have to try to bring these things into alignment. But having interest rates at low single digits is only just fueling dollarization. And this is such a sad thing. Nigeria is re-dollarizing. We de-dollarized in the early 2000s, where we stopped saving in dollars. We are re-dollarizing now. And just look at the numbers. Everybody's buying dollars and shoving it into domiciliary accounts or under the beds, notwithstanding that dollar returns are, in some cases, even as low as that. Thank you.
Well,
Okwemi, please pause.
Yes.
I cannot resist Bismarck. He's the reform person. The benchmark rate, the Central Bank of Nigeria's benchmark rate, is an orphan completely unrelated to any other rate in the market except by the explicit ties that the authorities have created. What do you think has got to be done to bring that rate back as an instrument of monetary policy control or influence?
You're asking a very fundamental question. Part of the work that is going on in evaluating the performance of economic performance of this country, including that of the fiscal and monetary authorities, is to ask yourself the first question. Are we practicing what they call, is the framework for monetary policy that of inflation target? Number one. If that is the case, then what is the anchor? The question you're asking is the anchor is an anchor without a ship. It's pulling nothing, right? The MPR. There's no relationship between the MPR and any other rates. So the interest rate structure is divorced from the anchor rate. And therefore, it's no wonder that you have an inflation target of 6 to 9%. However, inflation is hovering at 15, 16%. Right? One. Two, it's no wonder that you have multiple yield curves. That is, you have secondary market, same Nigerian paper risk, 90 days or 83 days and 90 days, different pricing. That's inefficient. So the interest rate structure is inefficient, right? The yields do not reflect any form of risk. The anchor does not, pulls nothing. Therefore, you are actually determining money market rates and monetary ability with an minimal approach. So we need to bring some structure back to it, right? We know, and it's difficult, but it is there. It's possible. So, and the whole process of bringing this back to normal has to start. If you don't start, you are going to be using one thing to patch up the other and patch up. So you'll have a patch work, right? There'll be a pattern to the patches, but it won't do any good. So that is part of the whole open market operations for liquidity management. You shouldn't have things more than 180 days paper there. Those rates should be there. The debt of federal government should be securitized, so it's taken off the books, right? Then you now have the primary market auction tied to expected rate of inflation, not just historical inflation, expected rates of inflation. Then you have yourself, ask yourself, if by doing this, you now begin to have growth, you can't have growth without having some inflation. So there's what they call a natural rate of inflation. There's no problem with it, 8, 9, 10, 11, 12. But if we are achieving growth of 7, 8, 9%, I'll take it. Well, what we don't want is stagflation. There you have inflation, high unemployment, and low output. Then it's game over. So we must do this. This is nothing esoteric. This is nothing. There's no drama in this. It can be done. It is being done, but it has to be done quickly. Because we have weeks, not months, to get this thing right. Like I said, I always end up by saying that if we don't do it now, it's lights out for Nigeria.
I mean, applause just, but you got like 4 minutes.
Well, just. I mean, after the two treasurers and I've spoken. My own sense is just that there is incoherence around monetary policy right now. Interest rates, exchange rates. There's, strategists look for fit and consistency, and we don't have that. So we have ad hoc, arbitrary. Everything is going in a different direction. Interest rates, exchange rates, inflation, all of that, and so on. I think the reason is because we have not focused on the fundamental, and I keep emphasizing that. If policy is because somebody is not doing the things that must be done, that somebody in CBN is running around trying to control the things that cannot be controlled. If we focus back on the fundamental structural economic reforms that Nigeria needs, if we get growth happening again, if we get investment flowing in again, both domestic, like I said, and foreign investment. If we get our policy environment stable and less misaligned, then we can see inflation come down. Then we would be able to have rational interest rates. Then we can begin to be more confident if investment is flowing in about allowing exchange rates to be managed by the market. So for me, trying to control everything when the fundamentals are wrong is the source of the problem. Let's focus on getting the fundamentals of policy right, get the structural economic reforms done, get investment flowing, get GDP growth back to 6, 7, and then higher, and then you would find that it will be easier to manage all of these macroeconomic indicators.
Thanks, Okoyemi. Thanks, Ini. Thanks, Bismarck. And thanks, everyone, for the patience with which you have endured this session. Ade Morayo, my job is done.
Wow, wow, wow. Did anybody feel like they were sitting in on an intellectual banter? Thank you so much, everyone. It was really amazing, hearing the different perspectives from the two treasurers and Mr. Agbaje, and all the seasoned experts that we have here. Thank you so very much. Guys, can I have our applause and our thank yous in the chat box? It's been amazing. So many nuggets to learn. I want to see all the thank yous, yes, and all the icons saying thank you, thank you, thank you. Yes, it's been an excellent session. Thank you so very much. We really, really, really appreciate this time out. I will just quickly run through some of the questions that we have in the Q&A. Certainly, we cannot take all the questions today. Please confirm that my volume is good. You can hear me clearly now.
Yes, we can hear you.
Yes.
Great.
No,
Apologies, I had a bit of techie issues when we started. So we would go through some of the questions. We can't take everything, but we will get all our experts here to answer the questions that we cannot take and have them on our website. Please be sure to go to our website, and you have the recording also uploaded there as well. So let me quickly go through the questions and take a few before we call it a good afternoon. All right, I have this question again from Gerald Lutana. And it says, from Mr. Bismarck's slide, the majority of our income come from the oil and gas sector. This means that the country's dependence on this sector is so high, which Mr. Okoyemi has confirmed, and our country will be doomed if oil rates fall below 50%, and the end users are the ones that will suffer most. Please, how do we balance this horde so that our so much dependence on the oil sector will reduce drastically? Can I have Mr. Ini attempt the question, sir? Hello?
Yes,
Okay.
I'm there.
Thank you.
Well, I guess, it's back to the central theme that's been spoken about today, which is really about reforms and following through with reforms over multi-year periods to get the desired results. I kind of like what Mr. Agbaje highlighted before and how he described it. And I think it's very apt, and I hope people listened, where he said, we've wasted the opportunity that a crisis presented. I mean, it's the same things that most economic watchers have been talking about for the last, I don't know, for decades, I guess, around lifting subsidies, doing things that will allow investments in key sectors of the economy. The truth is, government can't do anything, but what government needs to do is provide the right frameworks or the right environment that allow things happen. I say two things, and there are two clear examples, in my opinion, of how we've gotten substantial reforms in core sectors of the economy that have worked. Telecoms. Prior to the licensing round for the GSM telcos, how many lines did we have in this country? Government continued piling money into NITEL, didn't work, right? Look at the amount of investment that is going into telecoms today, and it's all fundamentally from the private sector. domestically or internationally. Cement. Nigeria went from being the largest importer of cement in sub-Saharan Africa to a net exporter over a period of time because of concerted, combined regulation and oversight from various entities that made it happen. It is exactly the same way we should look at critical sectors of the economy, right? Why have we been dilly-dallying with refining and the petroleum sector for so long? It took us how long to get our PIB passed, and arguably, we may have missed the boat in terms of where new significant investment is going to happen, whether it is in crude oil exploration or gas. So it's the same things in my view, and that's what's going to change things. That's what's going to help us diversify the economy. That's what's going to allow us generate alternative sources of foreign exchange. Nigeria has significant advantages, right? AFTA is coming, and Bismarck is right. We've signed it. So people can set up shop in Ghana. We're all complaining now when we hear companies, global entities setting up shop in Ghana. We say there's no market and that market is in Nigeria, but the environment is better. So they'll go there and ship the goods here. So we need to get our act together. So we produce here. We have the market, right? And it's something we need to mine. It's something that we need to harness so that we can generate and stimulate growth. And we can go on and on and on about so many things that just need to be fixed. The port situation, so many things. But it's all about reforms and following through. It's not just about listing and talking about it, but getting it done. Thank you.
Thank you very much. I do have another question for you, sir, and this is around FX dependency, and this is from an anonymous attendee. So where do you see the FX market in 2022 against the backdrop of the supply issues raised and our dependence on FX for most things? If you had a crystal ball, which is what we are trying to do today, what do you think is the fair value of the Naira for 2022?
Okay, that's a good question. I think we kind of answered that earlier on, because unfortunately, a lot of that is driven by policy. And we believe that the central bank will be a little more lax in terms of allowing convergence, which in essence means the official rate will move closer to the parallel market rate. Now, it also means, and I highlighted this before, there's a fair bit of speculative bent in the parallel market. So today, wherever that parallel market rate is, it's that high because a lot of people are speculating, believing that the Naira may devalue further, and it's all there. So we believe the official will go up and the parallel market may come down to some extent, and we should get some equilibrium, provided the central bank follows through on what it appears to have started, respecting some moderation around its foreign exchange policy. And we believe that's the case because it's inevitable, given where we stand, and we simply cannot continue to afford to continue on the same FX policy approach that we've done for the last couple of years. So we think that's what's going to happen over there, and that's how we see it. So I think we should
if I may come in here,
yeah.
I would say that our projections are that the reserves are at about 40 billion. You knock off some of the swaps and all of that. If we put in about $1 billion a month from the reserves, including whatever our revenues are, we can stabilize the currency, have a mechanism that that looks at terms of trade with our top 6 trading partners and have some kind of equilibrium there, and allow the crawling peg go from 430, 440, right? You will easily get convergence around 480, something about 490, 480. So that way you have fair value in that band between 440, 450, and 480, 490. And there'll be enough supply and demand, and then there'll be inflows to come in. So what you are not getting from your tradables, you'll get from your invisible inflows. And therefore, there will be kind of equilibrium all the way, at least for the next 18 months. That will be fair. That's our fair call. But you must have the courage to make sure that you put supply into the market and you do the interest rate move that we talked about. Those three things have to happen simultaneously: increase the interest rates, increase the supply in the foreign exchange market, and at the same time, allow that exchange rate, the current peg depreciate. That way you come to straight equilibrium. Don't forget, a couple of years ago, foreign market was at, one was at 360, the other one was at 364, something like that. And it was like that for over 18 months, just 3-4 naira difference. And nobody cared, nobody cared about BDCs, the market was efficient. So I think that's where we are likely to end up, elections or no elections.
Thank you so very much, sir. Thank you for that answer. I would have to take this last question because we are 6 minutes beyond our 3 p.m. cutoff. And incidentally, I will direct this question at Ini, who is also going to take the closing remark. And it says that what do you anticipate as the effects of the change from LIBOR to SOFR has been currently adopted in other jurisdictions going to be on our financial institutions, consequently looking upon the effect for the Nigerian customer?
Okay. I mean, that's a good question. And yes, we're all aware that the LIBOR standard is migrating because of issues that happened in global markets a couple of years ago. But as it affects Nigeria and our Nigerian clients, I think the impact will be minimal. And the reason is, for most of the indexed lending that we do in Nigeria, and fundamentally most of our foreign currency lending is in US dollars, so I think that's what's more important, is it's relatively short term. That's number one. So the impact of changing the underlying index to a SOFR index, or whichever one becomes the true adopted market standard, will be minimal. I mean, because there are two buckets when you look at it. One will be around trade finance, which is relatively small. And then the second will be around some of the larger hard currency syndicated facilities that you typically find in the, with the bigger, larger corporates. My sense is, and when you think about it, the credit spreads that we lend at in Nigeria are sufficiently wide that the change in the base index is immaterial. And what do I mean? Today, when we look at trade finance, if you want to open an LC, banks would typically charge you anywhere from LIBOR plus 6, 7 to LIBOR plus 10, right? So if the LIBOR index, which the LIBOR today, depending on which tenor, is around 1% to 1 point something, if that really changes, because the credit spreads are that wide, it's really immaterial in there. And then for the larger, longer term bigger type transactions, because again, the underlying funding for such term exposure, we're doing 5-year term loans in the oil and gas sector, or to support telecoms or whatever it is, we as banks will typically draw on our funding or our own market access. So we'll mirror what those kind of terms that we'll see. So I don't think the impact will be that significant to the bulk of our corporate clients. It's still relatively in flux, but for the bulk of the clients that will be faced with it, I think it's of minimal impact to them. Thank you.
Thank you so very much. And it's a wrap from us today. Thank you all for tuning in from everywhere across the globe. We appreciate your time here. I'll hand over to Ini to give us a closing remark and vote of thanks.
Okay. First of all, I'd like to start by saying a big thank you to keynote speakers today, Mr. Bismarck Rewani and Mr. Kwemi Agbaji. On behalf of First Bank, we really do appreciate your honoring our invitation and giving us your time, providing valuable insights on our economy. and what to expect in FY 2022. We all agree 2022 is a critical watershed year, as they typically are pre-election, and lots of changes to be expected. As always, at First Bank, we'd like to try to do things that will benefit our customers, and your insights that you provided today will help provide some clarity and understanding of the dynamics that they will face in the coming years. At First Bank, we remain committed to supporting all of our customers, and we will work with you to navigate the uncertain times that have been outlined today. So I'd like to thank everybody who registered and signed up. Looking at the numbers, I believe we had over 2,000 participants, and we hope you all found it useful. We apologize to those that we've not been able to answer all the questions. I've been looking at them popping up on the Q&A and the chat boxes here. And as our moderator has stated, we will put a transcript of this event on the website. We will send the presentation out, and we will endeavor to answer the questions and publish them accordingly. So thank you to everybody for participating at the First Bank Nigeria Economic Outlook for FY 2022. It's been our pleasure to deliver this, and we thank all of you immensely for giving us this time today. So thank you very much, and we all look forward to a much more prosperous 2022. Thank you.
Thank you very much, Lini. Thank you, everyone, and to all our viewers.
Are you a
thank
business
you, and have
owner?
a great year.
Been in business for